Good evening, everybody. Sorry for the delay, which is not unusual because we have connection problems with Omnovia all over the United States sometimes. So hope everybody's having a good evening. Tonight we've got the great pleasure of having Peter Schultz here with us. He is as you read in his background that I put on the chat room, he is probably one of the best, I want to say, instructors, traders that can teach you how to use credit spreads. So I'm not going to delay any longer since we're running behind. Peter, welcome to the Candlestick Forum. We're anxious to see your information tonight.
Well, thank you so much, Stephen. Can you hear me okay, first of all? Is it coming through all right?
Yes, everybody can hear you.
Okay, fantastic. Okay, let's get rolling. I realize we're running a little behind, so I'm going to try and be really respectful of your time and really get going and get through these slides. So the title of this presentation is How to Wake Up Every Morning $285.71 Richer. So this is the title of the presentation, so that's a really specific amount of money. So I want to show you a very achievable way to do that, and something very realistic and a very high probability of doing that. And just so you don't have to do the math, that's about $2,000 per week and about $8,571 per month. So just want to introduce myself real quick. My name is Peter Schultz. I'm the president of Cashflow Heaven Publishing. I'm the chief strategist for The Winning Secret. And we publish several different trading letters and investment letters that are all tailored towards increasing your monthly cash flow. And I think everybody is, when they first get into trading and investing, they have lots of dreams of hitting one out of the park, becoming millionaires overnight, making huge amounts of money. And but it seems like when I talk to most folks, what would really make a big difference in their lives is just having a little bit more money coming in every month. And even $1,000 or $2,000 extra coming in a month can make a big difference. And so that's kind of what we've dedicated our company towards. And the particular aspect of that, that whole philosophy that I personally write and research and put information out about is actually cash flowing the options market. So we all do lots of things to make money, and they usually involve our time and energy, and we're all really familiar with that. If you weren't born rich, if you weren't born with a huge inheritance, you probably got trained out there and went out and got a job. Now, this is one of my favorite painters from back in the 1930s and 1940s, and a lot of people worked in factories back then. A lot of us now work with computers, other things, but we're still trotting out there every day working and trading time for money. So the idea of somehow making money in our sleep is extremely compelling. And what I always wanted to be is the little piggy that wakes up rich. And I got to tell you, when I was younger, when I first started out in the work world, I was about 19 years old, and I was raised up in Alaska. And I went up, I was fortunate enough, everybody wanted these jobs because they were really high-paying jobs, and I was fortunate enough to get a job up on the north slope of Alaska in the oil fields. And I was a little worried. I was a little scared. I knew conditions were pretty tough up there, and I was a young man. I was 19 years old, and I was pretty interested in girls back in those days. And I asked one of the old timers as we were getting on the airplane. I said, are there any girls up there on the north slope of Alaska, up there on the north coast? And he smiles, he grins at me, and he says, "Yeah, behind every tree." And I get up there, and I get off the airplane. I look out at this totally bleak landscape, flat as a pancake, and not a single tree in sight anywhere. So really tough working conditions. It was in December. It was dark just about all the time. It was extremely cold. Some of my bosses were a little psychopathic. They were alcoholics. They'd like to scream and swear and throw things around. And I used to go to bed every night in my little bunk. We have these trailers out there on the Arctic.
Peter,
frozen wasteland. The wind's blowing. Yeah.
I'm sorry to interrupt you again. Yeah. We're still getting a little bit of scratchiness on the microphone. Try to figure out what.
Okay.
It kind of gives a little.
Is there maybe a different setting that I should do or something maybe?
You see where the microphone is over just below the list of everybody? If you put your cursor.
I actually can't see any of the Omnovia platform at the moment. It's all blocked out except for my slide.
All right, try moving your microphone a little bit further away from your mouth. Let's see if that works.
Okay, it's about as far away as it can get.
Let's see. You've got a headset on, is that what it is?
Yeah, correct, exactly.
Let's see. Is that my, yeah, might just have to talk softer then.
Okay, I'll do the best I can, and I apologize if you're listening right now and it doesn't sound too good, but hopefully the information will be worth it. Anyway, the point that I was trying to make with that big long story is I used to lay there in bed, I'd pile up all my clothes on top to try and stay warm, and I'd think to myself, you know, if this is what working's all about, I'm not sure I'm up for this for the next 40 years. And way back then, I started thinking about ways to somehow get my money working for me, or if there wasn't some way to not have to sign up for that program. And you know, you don't have to be up in the Arctic, you don't have to be freezing to death to have those thoughts. If you've ever had a bad boss or a bad working situation, you know, the idea has to cross your mind, you know, there's got to be a better way. And I know I'm kind of preaching to the choir here because every single one of us that's a trader, we got into it for that reason. So the problem is money doesn't come from nothing. There needs to be something, some mechanism to produce that money. So if we want to produce money without our labor, we need some kind of a machine to do the work for us. And this presentation will show you, the purpose of it is to show you how to create that machine. Now, the good news is others have already spent millions of dollars and thousands of hours creating the factory where our machine will work. And that factory is the various options exchanges. Interestingly enough, usually in business, you know, there's consolidation. So there might be a whole bunch and it goes down to a very small number. But in the last few years, we've actually seen an increase in the number of options exchanges because most of them are electronic now. So there's 12 options exchanges at last count. Most of us know about the Chicago Board Options Exchange, which is still the biggest. And you can see this little graph here, the percentages of the business that each one of them has. The good news, of course, is they're all accessible from your home computer or mobile device. And what we're going to talk about today is a method of trading that just is not super intense. It doesn't take a huge amount of attention. You don't have to be hovering over your computer all the time, which I personally really like. So that gets us to this next screen. Most people say don't active traders need multiple screens to see every tick in real time. And we all know people that are like this. Maybe you're a person like this that has a lot of screens and really watches the market closely, has level 2 quotes, really gets into the market. If that's what you do and that's what you like to do, more power to you. I take my hat off to you. That's fantastic. What I want to show you is a way to do something a little bit different, a little bit more passive with a big chunk of your money that you're not actively trading. So the whole idea is making money is only half the equation. The other half is how we make our money. So if you're an active trader, if you've been involved in that, you can really get caught in the ups and downs of the market. And it's really, really cool when you can create a mechanism where the money is kind of, and the strategy is kind of doing the work for you. So, you know, do you want to be the guy on the left or the guy on the right? And I love this old stuff. This is an old cartoon from 1948. And what we want to do is create a machine that's so good it might just work better without us than with us, with the exception of a little tinkering now and again. So the one guy with the cigar says, this machine turns out real bona fide currency of the realm, good American dollar bills. Or the guy in the green suit says that, and the guy with the cigar says, I'm still not sold on this thing until I can see it work. What's the clicking sound when you turn the handle? And this is kind of the way I want you to be right now. I want you to be a little skeptical, and I want you to be really investigative with your mind as far as how this works and can it really work for you. So the most efficient way to make money without a lot of our own effort is to employ forces that work all the time. So some people call these ever-existing elements forces of nature. A really good example of that is what we're seeing a lot in energy production with solar power, with wind power, with even harnessing the tides to create energy. And these are forces that happen all the time around us, and we don't really have to do anything to make them work. Whether we're here or not, these forces of nature will always be at work. So the force we'll be putting to work for us is one of the most constant and unrelenting in the universe, and that's time. And if you don't believe it, just ask anyone who's getting a little older. I swear, the time just seems to go by faster and faster the older you get. You watch your kids grow up, you watch it just spin past. Time goes by very fast. And it goes by incredibly fast if you happen to be an options buyer. So as you may know, the one most important characteristic that separates options from stocks is that options have a defined lifespan. Eventually, they all run out of time. That's the nature of options. Even if you buy a long-term option like a LEAP, they all have that expiration date where the option is going to cease to exist. Now, if you've ever bought a short-term option hoping for a certain move in a stock and that move does not take place, you often feel like this guy with the clock here, where you're just almost panicked and time is running out. So if you think time goes by fast in your life right now, just buy a short-term option and speculate on the move in a stock, and you'll be shocked at how fast time goes by. So the question is what are we going to do differently, and what is this strategy and why does it work so well? So there's many estimates as to the percentage of options that expire worthless every month, but most come in somewhere around 85%. So if you think about that figure, the vast majority of options, 85% of them expire worthless. Now, if you go on the internet and research this, you'll see different estimates. The CBOE disputes that. But there's no question about one thing, and that is options are constantly losing value. A lot of people sell out of them for a small amount of money before they become completely worthless. So you're really splitting hairs there. The point is, options are like insurance, and a lot of people buy them to hedge a portfolio. They're never planning on cashing in on that option. In fact, they hope that they never have to use it. So it's logical to think that the vast majority of options do expire worthless. Now here's something to consider. So many interesting facts around this. According to the Options Clearing Corporation, over $1.2 trillion worth of options were traded last year. And this year is projected to be even higher. So that is a huge amount of money. Huge. It's almost like a mountain. Just picture this huge mountain of money. And the big question is if 85% of that money just evaporates, sort of goes up in smoke, where does all that money go? And this is a question when I first started trading options, and that's going on almost 20 years ago now. I've been an active options trader every single day. I used to make these really speculative moves, and it seemed like I won just enough to keep me in the game, to keep me interested. I'd win the big prize periodically, and I'd dive back in there. And when the stock zigged instead of zagged, and something happened, and the market turned around, as markets often do, and my option expired worthless, or I lost a lot of money on it, I thought to myself, where does that money go? And at first I thought it was destroyed, and then I thought, no, I don't think it's destroyed. I think it's a zero-sum game here. There's always somebody else on the other side of that trade. And finally, you might have this figured out already. It took me a little while. This big light bulb goes on above my head, and I go, oh my gosh, all that money goes to the option sellers. And it's true that 85% of $1 trillion every year goes to the option sellers. That is a huge amount of money. So the solution to getting on the winning side of options is to become one of them. And I found that to be so true. If you like to speculate with short-term options, I sure understand. That's all I did for years and years. And I still do. When I see a really good trade setup, one of the things I love about Steve and his programs is he's really good at showing you good trade setups, and you can get really good at technical analysis. But I still do that with a tiny amount of my money, maybe 10% of my trading capital. I do it for fun, and I do it to occasionally hit the big home run. But the vast majority of my capital, 90% of it, I've jumped over onto the options selling side. So the big trick to become an options winner over a long period of time is to become an options seller. And that's exactly what we're going to talk about, and we're getting into the specifics. I want to give you this introduction because there's some very good reasons for becoming an options seller, and I don't want to overlook those reasons. I think it's really important. So let's get into the nitty-gritty of how we're going to do that, and this is a good spot if you want to take some notes, if you want to maybe learn some things you didn't know before. This is a good time for us to kind of get into that. So The first thing that I want to point out here is one of the biggest keys to winning is the time value of an option does not deteriorate in a straight line. So it's a really good idea to kind of learn what an option does and how it behaves. So what we've got here is these different time frames. So this is 1 month out. This is 2 months out. If you're looking at the screen here, you can see this. 3 months out and 4 months out. So from 4 months out to 3 months, you can see that the time decay is almost flat. It's very, very gradual, just a tiny amount. In 3 months to 2 months, it accelerates a little bit. It goes down at a little bit faster pace. Now, what gets interesting is from 2 months out to 1 month out, there's a point here in the last week before that option becomes front month where you can see where the curve kind of steepens up a little bit. This is traditionally where a lot of people used to sell their options because they get that bump. When the option goes from the second month out to the front month, they get this big bump in time decay. But the most interesting part of this entire time decay chart that is just absolutely fascinating is this portion of it right here, and that's the last 30 days of an option's life. The time decay in the last 30 days is absolutely huge. And if you're a real short-term option seller, you can see time decay happen, the last couple of days. It's almost an hour-by-hour thing. So we've done a lot of research on this, and one of the biggest advances in options and one of the most exciting developments in options in the last 10 years is the experimental introduction of weekly options back in 2006 and 2007. And then weekly options used to only be around for 1 week. So they'd introduce them on a Thursday, they would expire the following Friday. Then in the spring of 2012, they decided to try something different, and that is where on some really heavily traded indices and stocks, they would actually have expirations every Friday during the course of a month for something that's really heavily traded like the SPX or the SPY. So all of a sudden, for the first time ever, you can actually pick your expiration date. That's when we did a tremendous amount of research, and we found that the perfect time to sell an option is from 1.5 to 2.5 weeks, this portion right here. Now keep in mind, when you sell an option, it's kind of a balancing act. You want to get a decent amount of premium. You want to get pretty good premium, but you don't want to sell too much time. Basically, what selling options is all about is it's a race to the finish line. So if you ever used to play tag as a kid and there was a base and you came out from your hiding spot and the person that was trying to tag you, the minute they spotted you, they started chasing after you, and you were running as fast as you possibly could to base. Well, base is expiration. It's right down here at the close of trading where that option ceases to exist. The whole point is you want to get to base as quick as you can, and you want that option that you sold for pretty good money to expire worthless. And we found that we can get pretty good money selling it 1.5 to 2.5 weeks of time, and then it's a very accelerated time decay going into expiration. These studies on how options work and how they decay and where you can sell, it's kind of changed a little bit over time on when options expire, what Friday you can pick, and also volatility has a huge amount to do with the time value of an option. So as volatility changes, in the last week or two, we've seen the VIX, the volatility index, just shoot through the roof. And all of a sudden, we can sell much further out and still get some pretty good money. So this is important. Now, the big difference here is people used to sell about out here, like I say, a little bit more than a month, just in this area right here. And you would have to wait perhaps 5 weeks for your payday unless you closed the position early. Then you could collect. But you only could turn your money about every 4 to 5 weeks. And that was fine. That's not bad. That's way better than waiting a year or longer. But you only got a payday about once every 4 to 5 weeks, so once per month at best. Well, what's happened since these new weekly options is we've now got 2 paydays. We try and shoot for 2 paydays a month, and we turn our money twice as fast. So it really has made a huge difference it's made a huge difference as far as how often we can turn our money and the compounding rate on our money. And as you can see, if you start to do this consistently month after month and week after week, you are going to create a huge buildup in your brokerage account just because of that compounding. So we really compressed the same rate of return in half the time. And from a mathematical standpoint, you can imagine what a huge difference that makes on your returns over time. So here's how the strategy works. Now, if you're familiar with options, if you're familiar with selling credit spreads, you know, we can just kind of go over this as a quick review. But if you're not, this is pretty fascinating stuff. So what we do is we use the things that you already know about technical analysis. So all the things that you've learned in you know, candlestick charting and other courses and education that you've taken to try and determine what a stock is going to do, what's going to happen with it. So here's a typical spread we might do. So we put on the spread here. This is my actual commentary. So I've got a subscription service, a lot of subscribers on there. People do really, really well with this service. And this is typically what you'll see. So here's one of the charts. The SPX has a well-defined uptrend line. It's following plus several areas of horizontal support. It's not likely to breach. Good conditions for two new spreads. Now keep in mind that this was back in September. And this chart goes back a little ways into August. So it was a little bit, quite a bit more mellow and well contained than it is right now. So this was the chart that we had to work with at the time. So we'd have this big rebound. It came up kind of trading sideways here. Could possibly roll over, but at this point it's sideways. So it's come up kind of stalled. So we sell this spread. So we got, the way that this works is you sell the near spread. So this is a call. You sell this call, and then you go out as close as you can, just $5, and you buy a call to hedge. And on the call side, we got 55 cents. Now, typically, what we do is we don't put both of our spreads on at the same time to form a condor. We wait a little bit. It sort of came down. We had a couple of dips here, and we put on a put spread. So in this case, you sell a put. The put that you're selling is closer to the underlying, so it has more value than the one that you're buying. So you buy another put just $5 away, and we got 35 cents. So this just kind of shows the process here. Why do you want to buy this put as a hedge? Why do you want to buy this outside one? So your only liability on this trade is $5. So you don't want this infinite, unlimited liability when you sell an option. You want to really limit that. And so in this particular case, on this spread here, this was expiring at this particular date, we got a total of 55 plus 35, or 90 cents on a $5 spread. And I'll show you how to figure that out. On this one right here, we did the same thing, kind of dipped down a little bit right here. We sold this put spread. On the put side, we got 40 cents. It's a good amount to get. Over here, we let it climb a little bit, and when it popped higher, we sold a call spread. This is with a different expiration date, another week out. So the neat thing about this is if you're trading things like the SPX that have weeklies, you can now get a payday every week. So you sort of parse your money out. So it's sort of divided into different time frames and different strike prices. So every Friday we try and work it so we have a payday. So we have money coming in just constantly. So on the call side, we got a little bit more. We got 40 cents. And once again, that's a 90 cent credit altogether. So the way this works is we have a 90 cent credit. I just want to do the math for you real quick here. So we have 90 cents. The most we can lose is $5 because of this $5 spread, except we've already got 90 cents, so the most we can lose is $4.10. So we subtract our credit from our spread, the $5. So our risk, or our investment in this case, if you want to look at it that way, is $4.10. So 90 cents divided by $4.10 equals 22%. Now keep in mind, in this case, this is not for a lot of time. You can see the time here. This is a very short time. This was actually just about 3 or 4 days. This was about 2.5 weeks right here. This is about 2 weeks on this bottom one, about a little over a week on this top one. So we're averaging about 2 weeks, and we're shooting for a 20 to 25% return. And this is kind of the math right here. Now, one of the cool things about this is if you already have a spread, for example, this one on the downside, this is a put spread. You can see this here. You already have that in place. Your broker knows that this stock cannot close both above and below your spread at the same time. So there, even though you've got two spreads here, two $5 possibilities or potentials, they're only going to make you hold the margin for one. That's why you can get a credit on both of these, almost really double your rate of return, and still just use $5. So once again, that math is you take your credit, you subtract it from your spread width, in this case $5, 90 cents, $5 minus 90 cents is $4.10. 90 divided by 410 equals 22%. So let me clear these. So 22% in 2 weeks is pretty amazing. So I know if you're a short-term trader and you're a speculative trader and you like to get in there, maybe an options trader, and you go 22% in 2 weeks, what are you talking about, Peter? I'm a swing trader. I make 22% in 2 days. I sometimes double my money. I'm into buying really, low-cost options that have the potential of doubling, tripling. Why are you boring me? Why are you talking about this 22% in 2 weeks? Well, I'll tell you why, and why it's so different than the trading that you might be doing right now. Out of all these big benefits, and here's the 3 big benefits of spread trading, credit spread trading. You have a relatively short holding time. So remember, it used to be a month to 5-6 weeks. Now we've got it down to 2 weeks. We've got generous returns. When most people talk about credit spreads, they're going to talk about 5 and 10% returns. We're typically getting 20 to 25% for 2 weeks at a time. So relatively speaking, really generous returns. But this is the one that I really want you to look at, and the one that's perhaps completely different than the kind of trading that you're doing right now. It's the level of probability of winning. So, I mean, it's just absolutely huge. And the more you're in the trading game, the longer you're in it, particularly when you're trading derivatives. Like if you're a Forex trader, an options trader, something with a lot of leverage that really moves dramatically based on what the underlying is doing, probability is so darn important. So let's just take a look at how we can determine our probability. So one of the spreads that we did on the SPX was, this is the call side, so this is the Thinkorswim platform. It actually shows you your position. And here's, for those of you trading the Thinkorswim platform, you can actually, it's a really, really cool platform, and you can set up these columns that you see here to be almost anything you want. They give you all these really great choices, and they have all these little drop down little golden arrows here where you can actually set that up. And so the way that I like to do this, if you're a spread trader now, or if you're thinking about doing it, I like to have my probability of being out of the money, the delta, and the bid ask right here. So one of the spreads that we did is we sold right here the 2035 calls. You can see these, and we bought to hedge the 2040 calls, and you can see those right over here. One of the really cool things about this platform is you can know your odds of winning before you ever put on the trade. So this is our probability of being out of the money, and that's based on the Black-Scholes model, options pricing model, and actually some variations of that where they've actually refined it a little bit. So you go down here and you can see that this call that we sold has a 91.29% probability of being out of the money at expiration. So if you're trading and you walk into a casino, you're flipping a coin, you're doing anything where you're putting some money on the line and it's subject to chance, how many times would you walk into that casino if you had over a 91% chance of winning? So typically we want to set these trades up to have an 82 to 92% chance of winning. Maybe 84% would be towards the low end, to 91% chance of winning. We really want those odds stacked in our favor. And when you do that, you'd be surprised at, with all the variations of the market, all the volatility, all the extremes, the unpredictability of the stock market, you might be surprised at how often those probabilities actually work out. So the mathematicians that put together these formulas, I think, in my opinion, actually did a pretty amazing job. So if you had a 84, 85 to 92% chance of winning on every trade, I think you'd be doing this a lot, and we do. You know, the people that do this, a lot of them are either making their living doing this, or they're really seriously supplementing their income. So one of the points that I want to make here is new traders typically concentrate on how much they can make. And they look at a trade, particularly derivatives traders, when you start getting into options and things that are really leveraged, and you go, oh my gosh, you know, if this thing could double, it could triple, I could just make this huge amount of money. I know when I first got into options trading, I had some good wins right in the beginning. And I thought to myself, my gosh, you know, this is as easy as falling off a log, and I wonder what color my Mercedes-Benz is going to be. And after a while, I kind of learned the big trick is to preserve your capital. So experienced traders concentrate on their likelihood of winning. And one of the things that you really want to do, no matter what strategy you're using, and maybe you've got something right now that's working really well for you, but the key is to stack the deck on every trade you make. When you go into that trade, you want to set things up so that you really have a tremendous probability of winning on your side. That's what this strategy does, and that's what I like about it so much. Now, the other big benefit is once the trade is placed, you really can make money in your sleep, because time decay never sleeps. It's going on 24/7. And the truth of it is most of the time you don't have to do anything. So if you think about it from a probability standpoint, if our trades have a, say, an 84 to 92% chance of winning, logic tells us that about 8 out of 9 trades you're not going to have to do anything. They just quietly go towards expiration. We've got several that are expiring and worthless tomorrow. So we're really looking forward to that. But 1 or 2 trades you are actually going to have to adjust, and I can show you how to do that. And at the beginning of this webinar, we talked about how to make $285.71 per day, and I promised I'd be specific on that and show you exactly how to do that. So we're shooting for 25%. Let's say we get closer to 20%. So if you put 20,000 to work, and 20,000 is a reasonable size account, I know some people have literally hundreds of thousands to work with. Some people are starting out with just $5,000. I wanted to use 20,000 as kind of a low, medium range here that most folks could relate to. So if you put 20,000 to work and get 20% in 2 weeks, that equals $4,000 in profit, and divided by 14 days, that equals $285.71 per day, whether you are paying particular attention or not. So once you put these trades on, the time decay starts working immediately. And the way that we put them on, a week and a half to 2.5 weeks of time, it really starts working in your favor right away. So unless that underline really moves towards your sold strike very, very quickly, the time's just running out of the hourglass. And so if you've got a bigger account to work with, this number per day is going to be greater. If you've got a smaller account, you can work up to that. But I want you to know that this is a realistic expectation. And I want to show you some actual proof. Now, this is, we published this, and this is our track record. We publish it publicly for everybody to see. You can go to our website. It's cashflowheavenpublishing.com. The name of this particular service and strategy is called The Winning Secret, and that's exactly the way I felt about it when I first discovered it and started trading it. My success had been a little bit spotty, as you know, if you're a speculative directional options trader. When I really started selling credit spreads, the wins were just very, very consistent. So this is taken from our actual track record. This is in September. You can see right here we have, look at the time frames here. So this is 8/27 to 9/12. You're looking at about 15 days, close to 2 weeks, 19% return. Here we put this on 9/3. It expired on 9/12, so that's just 9 days of time, and we got a 22% return on that one. Here's Google. We did a condor on that. Put that on 9/10. expired on 9/26, so that's 16 days of time, calendar days of time. Actually, all of these are calendar days, and a 22% return. These are aggressive trades. We also have a Roth retirement or conservative portfolio, and that does just as well. So even though we're shooting for 20%, oftentimes the truth is we do better. And you know, you just look at this one right here. This is Google. This is this bottom spread, and you can just see here's our top spread here. Here's our bottom spread. You know, the thing just went right through on this particular upward ascending trend here, and it just expired worthless. And that's typically what happens to them. That's very, very common. That's what we get most of the time. Here's our retirement portfolio. Here you can see the retirement trades. Once again, 22%, similar time frames, 22% here, 19% here. So this is just very, very typical of what we're doing. So one of the things that you might be asking right now, and if you've been involved in credit spreads in the past, you know that kind of the enemy of spread trading is a volatile market. So you've got to be asking right now or thinking to yourself, you know, Peter, that's great. I'm glad you did really well in September. I'm glad you guys do well most of the time. But what happens in a market like we've got right now? What happens when the market gets stormy? I mean, when it just gets crazy. Now, we've had, a typical move on the SPX might be 5 points, 7 points, 3 points. We've seen days in the last 2 weeks where it moves 28 points in a day, 35 points in a day. I mean, we've seen this thing just go absolutely crazy. So if you sold credit spreads in the past, you know that what you don't want to have happen is for your sold strikes to get overrun. You don't want a spread to get overrun because you can actually lose quite a bit more than you make. So that's the theory, and that's why a lot of people avoid spread trading. And if you've tried it with without a lot of education, there's very, if you did get a super volatile situation, you could have lost a lot of money. But what we teach and our whole education really is designed to help people avoid those situations so they don't get caught in a situation where they really lose a lot. We set up automatic orders, last-ditch orders to close a spread when the sold strike is touched. I can show you how to set that up automatically on the Thinkorswim platform so you just don't have to worry about it. And oftentimes we close them before that. I mean, if we really get a radical move, if support or resistance is broken with a lot of force, and if you're into technical analysis and candlestick charting, you know what that looks like. We don't wait around. We go, hey, let's close this thing and let's roll out to something better, take in some more premium and get out of harm's way. So, I mean, you'd have to agree that in the last couple of weeks last 2-3 weeks is about a worst case scenario that you could possibly think of for the market. So, I mean, this is about as bad as it gets. The market's just absolutely been crashing. Sometimes there's short covering rallies and it just booms right back up again. Very hard to predict what's going to go on. So we place our spreads with a really high probability of winning, but in markets like we've got lately, it just does not work out. So let's just take a look at, is it possible to lose at this strategy and what happens when you do? So here's, we've got these are our most recent trades on the SPX. We trade other things, but I just wanted to show you these. This is a real common thing we trade. We've got 3 trades here, and these are literally kind of worst case disaster kind of scenarios based on how crazy the market's been lately. So we have a condor here that we actually rolled down, so we took in some more credit. So we ended up losing, you can see it right here, we ended up losing 5 cents on this. That's in some cases, that's about what a commission would be. That turned out to be a 1% loss on the trade. This one, we lost 90 cents when we closed it. We rolled and brought in another 90 cents. Expired on the 10th of this month, and that was flat. That was 0. We have a bull put spread here that we lost 15 cents on. That turned out to be 4%. So that's a 4% loss. And then just the other day, well, this just happened on the 15th. So this was just actually yesterday. We put on the bull put spread when the SPX crashed, started to recover. We didn't wait around for it to turn around. We bought it back. We bought it back at a profit, and we made a very quick, this was just in a few hours, 8%. So So typically we make 20-25%, but what you're looking at here is just this kind of worst case, super stormy market, really hard to predict, super volatility, absolutely crazy. And in a lot of cases, all of our call spreads, of course, are expiring worthless, which is great. So everything you're seeing that we're having to close here is, of course, on the downside, the put side. And you're seeing just typically what happens. And this is because the reason that we're really not losing much or any money here is because I've been doing this for a really long time. I've been actively trading credit spreads since 2003. We've been through some super wild markets. I'm sure there's some really wild markets coming up in the future. And just over the years, I've learned how to manage these positions. So when things start getting out of hand, we don't wait a long time. We'll close a spread. We'll let that thing get extreme. We'll open another spread to take in more money. We'll adjust. We'll roll out. We've got a lot of tips and tricks to make sure that you'll keep the credit when it looks like it's going to go that way. And most of the time, the market trades in fairly predictable patterns, or it just goes sideways. But when we have these really just outrageous, unbelievable breakouts, this is what you're looking at right here. And I'm very happy to teach all of that, show you the adjustments, show you what we do. And actually, that's a big part of the newsletter, is I take you by the hand. If something's happening crazy, we don't wait till the next Tuesday night when the new newsletter comes out. I just send you an email right away to let you know what to do. So most of the time, things actually work, pretty well. And so, of course, occasional volatility happens. But normally we get 20% or better, as you've seen from the track record. You can go back on the track record and you can look back quite a ways. It's not to say that we don't occasionally have a big loss. Occasionally something happens. There's a buyout announcement or something that you couldn't have seen coming. It happens, but it just does not happen too often. Very, very rare. So the bottom line is if you get a consistent 20% every 2 weeks, you're going to become very wealthy. That's an incredible rate of return. But let's get realistic. We live in an imperfect world, and the market often throws us surprises, like we've seen in the last couple of weeks. So the big question, and I love this, I don't know how many of you out there remember Don Knotts, but he was one of my favorites back in the day, and so here's his surprised face. So I don't know if he was a trader or not, but this is probably what it would have looked like in the last couple of weeks here when things were just going absolutely crazy. So the big question is how to stay happy in an imperfect world. And so I want you to think about right now, we've got a heck of a track record that I'm really proud of. In some cases, we've got entire months where we don't have a single losing trade, like in September. And occasionally, we, of course, do have a loser. I just showed you a couple, but they're not that bad, and we make a lot more on the winners. So just based on what you've seen so far, and you look at these probabilities, and what I like to say, tell people when we're talking about credit spreads is I say, close only works in horseshoes and hand grenades, but there's one place where close also works, and that's with credit spreads. You don't have to pinpoint and nail direction and timing like you do as an options buyer. You can just, set a spread outside of a stock's range or an index's range, and you can be close. You don't have to be right on, with where that stock's going to go. It can bounce around, it can move around, it can have some surprises, it can gap up, it can gap down. But if it never touches your spread by expiration, you're going to win on that trade. And I love how forgiving it is, and I love how easy it is to win with this strategy, as opposed to just about any other way to trade out there. I mean, it really, really cuts you the slack. So based on what you've heard, some of your experience, if you had some really good guidance, you had somebody taking you by the hand, and if you got some really good education around here, what do you think you could make? And so we're typically getting 20 to 25%, so you might have a reasonable expectation at this point of making maybe 20% on each trade. Let's just say, you're not that good at your entries and exits. Maybe you don't buy back exactly when you're supposed to. Maybe, you can't watch the market that close. So do you think perhaps if what we're typically getting is 20%, if you could get 15%? And what I'm trying to do here is I'm trying to set really reasonable expectations. Maybe you don't think you could get 15. Maybe, things don't go well for you in the stock market. Maybe you don't typically do really well. Maybe you can only get 10% every 2 weeks. Well, you know, whichever one of these numbers you think that you could realistically get, and I know you could get in here somewhere. I think you could do towards the high end. All you have to do is follow my instructions, get in when I get in. I tell you exactly when to get in. We set, your timing doesn't have to be perfect on this. You can set automatic orders. You can set good till canceled orders. And, you know, when it hits your price, it hits your price. You'll get your credit. You can get out the same way. So it's not really tough to get filled on these things. You can do this. But let's just say, for the sake of an argument, all you think you could reasonably do with the losses, with the crazy market, with things that are hard to predict, all you think you could do is down here at 5% with this strategy. Will it still work at 5% every 2 weeks? Keep in mind, we're typically getting 20. Let's just say, for the sake of an argument, and to take our expectations way down, let's say all you can really do in your own account is 5%. Is that still worth it? With the 80 to 90% of your trading capital that you don't want to watch that close. And if you're a speculative trader, I don't want to talk you out of that. Keep doing that. That's a good thing to do. But just take the bulk of your money and get it out of harm's way and do a strategy where you have a really high probability of winning. So if you can only get 5% every 2 weeks, how does that play out? What does that look like? So I was really curious about that, and I did a little calculation. If you want to go on the internet and figure this out for yourself, it's one of the funnest things you'll ever do. Go enter in Google compound interest calculator and put in there making 5% every period, and it keeps compounding. So in this particular case, we're shooting for about 2 weeks at a time. We're talking about just getting 5%, so the very bottom end of our expectations. If you have just not a $20,000 account, but if you have just a $10,000 account, after 2 years of doing this strategy, your $10,000 has grown to $104,000, over $112,000, and you're bringing in over $10,000 per month. And I just want to tell you, before you say this is impossible or this is crazy or this can't work, I've got a lot of subscribers that are doing exactly that. This is what I've been doing. It's the best way to build up your account I have ever found consistently. And we even have a special program. I've got a whole webinar on it, and I can show you that too, of how to do this in a Roth IRA. And all you have to do is, when you open your Roth, is tell them that you have options trading experience. You can do it at Thinkorswim or the broker of your choice. And you can actually do this strategy in a Roth, so your entire buildup and all of your income is tax-free. If you start taking that income after the age of 59 and a half, you don't pay a penny in income tax. And that's anywhere you live in the United States. It doesn't matter if your state has a state tax. You don't pay. Fantastic programs that Congress ever put together. I absolutely love it. And this is the perfect strategy for doing it in a Roth. It's absolutely amazing. Best thing for people that want to get retired that I've ever seen in my life. And the beauty of it is, you know, you don't have to be a trader that is on it every single minute of the trading day. You don't have to be hovering around your computer. The probabilities actually play out. Now, you can relax most of the time. You can even take a nap while this is going on. But about 2 out of every 10 trades, you're going to have to wake up. You're going to have to take a look. I'll issue all the instructions on that, so it'll tell you exactly what to do. But you'll have to close a position, roll out, and of course, you know, I want to show you exactly how to do that and the best ways of doing that. So it's super important to me that you're successful with this. So if you'd like to come on board, I want to make sure you've got absolutely everything you need to do really well. I know for a lot of people, this is a strategy they haven't done a lot before. They don't really understand. You might not even fully understand it right now after this presentation, and that's okay. I want to go into the ins and outs. There's a lot of things about options pricing that are good to know, and I want to show you all of those to really, really stack the deck in your favor on every trade. I want you to be successful. I want happy subscribers. That's how we stick together and stay with each other for a long time. So to make sure you have a really good understanding of how this strategy works, when you come on board, you'll get a complete video presentation called How to Trade Credit Spreads for Fun and Profit. And it really is fun, and it really is profitable. So it shows you step-by-step how credit spreads work, why they work so well, and how they can work for you. In addition, I've spent years and years putting together this educational package, and it has everything. You'll see how wide of a spread to sell, how much time to sell, what to do if the stock starts getting close to your spread, how many spreads to have on at one time, plus a big section on adjustments, which is what most people really want to know about. What happens when a trade goes wrong and how you can make it better. And you'll get absolutely everything you need to trade this strategy with confidence. And I used to sell this, I'll tell you, I've gone to international financial seminars, live events. I sold this on cruise ships for up to $2,500, and you might think that's a lot of money, but I still get emails from people that thank me for turning them onto the strategy that are still making really good money with it today. So you're not going to have to do nearly that much. I've got a really good value I put together for Steve and his people. So I just want to show you some of what you get. You get the 160-page downloadable ebook, complete with color graphs, charts, pictures, everything you need, plus a 15-chapter video series so you can see and hear how these things work. I actually take you through trades. I show you how to set them up. I show you what not to do, the things to really look out for. They say when you can see it and hear it, you retain the information and assimilate the information about 40 times better than just hearing it all by itself. But if you are in your car, if you are out jogging, if you're cruising around and you really want to turn your car perhaps into a really good place to get a seminar education, I've also got 14 separate audio files that you can download and listen to on your MP3 player or your iPod or even your phone. So I want you to be able to get this education anywhere you're at in the way that you really like the best. Plus, you'll gain access to our archived webinars so you can discover new strategies and ways to improve your returns. And you'll also have access to all new webinars for life as an owner of this package. So the package is a one-time fee, and I want you to have access for life. We keep adding new things to it, new improvements. It's getting better all the time, and I think you'll really love having it. Plus, you get 3 videos that show you how to set up automatic orders with our favorite broker, and that's Thinkorswim. And these are the videos that show you how to automate your trades so you don't have to constantly monitor them, providing peace of mind, knowing you'll get out of a trade if you need to at the exact right time without having to watch your positions. And I think that's really, really important to have a really good degree of peace of mind while you're doing this strategy. Plus, I'll show you what to trade, how to trade it, and when to trade. You get 2 new high probability trades every week. That comes out on Tuesday evening, late Tuesday evening, particularly on the West Coast. But you'll have it in plenty of time Wednesday morning to place your trades. And I'll show you exactly where to sell your spreads, exactly how to sell them for the possibility of maximum gains with minimum risk. This is a little screenshot of the of what you'll get, the newsletter. You just log right into it. Shows you which way the market's going, how the market affects us. You get two new trades with a lot of detail, and you also get follow-up information on all of our existing and open trades. So it's really complete, comes out every Tuesday night. I think you'll really enjoy it, reading it. I love writing it, love doing the research on it. This is really, really fun to make money this way because you just have the confidence, the strategy, and doing it when you set up your trades correctly. The odds are so stacked in your favor, you just really get used to winning, and that's fun. Plus, as an extra bonus, you'll get a 10-module video course specifically on trading the weeklies. So the weeklies are probably the biggest thing that's happened to options in the last 10 years easily. Everybody wants to know how to trade them. Especially people want to learn how to sell against them. What are the best strategies to do that? Because your time decay is just so darn quick. And it's a whole 10-module course. This has been one of the most popular things we've ever produced. People buy this for $150 all by itself. A lot of people ask if they can buy it all by itself. But what I want to do here is include this in the package, so you have this as well. Plus, to make sure you have everything going for you possible, you'll also get a special link to open an account at the best broker in existence for this strategy, and of course that's Thinkorswim. They have fantastic trading software that they're improving all the time. And once that account is open, we'll put you in touch with our dedicated team at TD Ameritrade to get you special commission rates set up just for this program. And a lot of people that are starting off, they want to trade just maybe 1 contract at a time, 2 contracts at a time to really get their feet wet. So what we've negotiated with Thinkorswim, which is really cool if you're just starting out, is to eliminate that ticket fee for our subscribers. So they normally have a $9.95 ticket fee. We're going to eliminate that. You'll just pay a per contract fee and you'll get your commissions down where it's reasonable, where you can do just a couple contracts and still do pretty well with the strategy. So just want to add that in as a bonus. And they really like our subscribers because our subscribers tend to win and become long-term customers for Thinkorswim, so they like that. So just in short, this is a train that you don't want to miss. It's really cool to trade this way. It's really fun. If you love speculative trading, keep doing it, but I'll tell you, take the vast majority of your money, put it in a strategy where you have a super high probability of winning.
And Peter, your sound is cutting out dramatically.
Okay.
Wiggle your head.
So let me just, okay, how's this? Can you hear me a little bit better? Basically, what I just want to conclude with is that's great. Thank you, Stephen. I want you to come on board so we can trade this plan together, invest what you can, and prove to yourself how well this works, and then watch your account build. And I've got a special promotion for, as a member of the Bigelow Circle, and this is at betterthancashflow.com. That's the URL. That program that I used to sell for $2,500, I've actually improved it quite a bit, and it's for sale on our website at $395 for a lifetime access, and it's worth every penny of that, and I'm sure you agree when you get in there and you start trading this. But I've actually bundled that with a subscription to make it even more affordable. So our subscription is $97 a month, which is incidental compared to what you can make on even one spread trade. And I want to combine that subscription with this package to give you a really, really attractive deal to get started. So I hope you come on board. I'm really looking forward to having you as a new subscriber and really showing you how to do this. Our customer service is second to none. We've got a couple of really sharp gals here that really know the program, that can really answer your questions. One of them, Alicia, has an advanced degree in accounting, super, super sharp, and exactly. So, Steve, was there any questions that people have that I could answer? My computer actually just completely shut down right at the very end there, so I just wanted to be able to answer folks' questions if they were interested.
Okay, so let's start over. Anybody have questions for Peter? Let me see. Any 30-day money-back guarantee, etc.?
There's a guarantee on the package, but of course, at the month-to-month subscription, we just use that every month, and then that month's been used up. So yeah, any of our education, there's always a 30-day money-back guarantee.
Okay. Peter, of the 85% plus or minus.
I want you to be happy.
Okay.
What's that?
Next question is, of the 85% plus or minus of options sold, do you know what percent roughly is going to the market makers?
Yeah, so that's a really good question. And when you trade options, I think it's really important to trade options that are very efficient, like certain indices and stocks that are really heavily traded. So the efficiency refers to the bid-ask spread. You want that to be as narrow as possible. So on the things that we trade, I do not trade inefficient options. I won't play that game, where it's like, bid at 50 cents, ask $1. I mean, your option has to double in order for you to break even. That just doesn't work. So a lot of the things that we trade, I mean, a good example is the SPY or the QQQ. That bid-ask spread might be just a penny. So very, very efficient. You don't lose that much to the market maker. And I think that's really important, if that answers your question. Once again, you're trying to get everything going in your favor possible.
Okay, and Achilles is asking, would this style of option trading be easier to learn than other methodologies geared more towards beginner option trader?
Well, that's where we have the education, and if you know any of the basics about options, this should not be difficult for you because I kind of start you at the very beginning. But I just want to let you know also that I'm working on a program right now called Introduction to Options and How to Make Money with Options. And that's going to be relatively inexpensive, and it's going to take people from the hand from the very beginning. I've also got a really cute little ebook that I can send you that's called The Credit You Deserve, and I think it'll make a lot of sense. It's actually got cartoons in it. It's written in a really light style, and it's not going to be heavy. I used to read a lot of books on options, and I used to rate them how many cups of coffee per page, because you just fall asleep at the wheel trying to read the thing, and so I didn't want to produce that kind of a book. So if you can remember that or write that down, The Credit You Deserve, and then call our offices and we'll email it right to you for free. So you can tell the gals here that I said that. And if you're curious and you want to know how this works, it's a really cute little way to learn about the strategy.
All right. Rick is asking, how, on average, how many spreads do you have going on at any one time?
Well, in the service, we do 2 spreads per week. So we've got we've got overlapping spreads and spreads that are getting ready to expire. So we might have, 8 spreads going on in a month. And then I might have other spreads going on personally, and I encourage you to do the same. One of the strategies here is called a condor, because one of your spreads that's way above, outside the range to the upside, is called a wing. Your call spread's called a wing. Your bottom spread, your put spread's called a wing, so that's why they call it a condor. It's this big, wide wingspan. And I've always told people it's a lot safer to fly a flock of condors instead of one condor. It's like, the hunter's trying to shoot us down, and they can't get all the birds at once. So I like to fly a lot of different time frames and a lot of different strike prices to really increase your chances of being successful.
All right. And what was the cost of the package again? It's showing on the site that it's $279 or $297.
Oh, well, that's only on the special webinar for this webinar. If you go to our website, the package all by itself is $395. But for the webinar special, we've got it at $297, and that includes your first month of the subscription. So you got the subscription at $97, and then you're paying $200 for the package. So that's half price essentially. Is what you're getting the package for as a viewer of the webinar. All right.
And Tom's asking, what's the smallest size account would you have to make the system work?
Thinkorswim will let you open a brokerage account with $2,000, and I want to know if that would work or not. So I've been trading some spreads in a little $2,000 account. Actually, my 14-year-old son wanted to learn about this, and I'm kind of flattered that he did. So I sat down with him and kind of showed him. And he's been saving his money forever, doing chores and working for other people. And so he put $1,000 into the account, and I put $1,000. And we've been trading it with $2,000. But I got to tell you, it's kind of challenging. You can't do very many contracts. It's a lot easier if you have maybe closer to 5,000. So you can do it with 2. I think you'll find it a little easier, and you can do more of the trades with a 5,000 account, if that kind of helps answer your question.
What kind of brokerage account do you need to trade the SPX or the SPY and futures? James, I guess, yeah, Thinkorswim has.
Well, futures.
Go ahead.
Yeah, futures are commodities, of course. That's a different thing. So we're trading equity options. And you don't need a huge account. Like, we're trading the options. So we're not trading, in futures, you're trading the actual S&P contract or the E-mini. And you do need to have, in some cases, you need a $25,000 account. You need all these approvals and everything else. But for options, getting options trading approval is not difficult. You just have to let them know that you've had some experience trading options, and, you've got the money to withstand a loss, and they'll approve you. And you can just trade one contract at a time. So you don't need a huge amount of money. Like one contract on the SPX, if you get $1 credit, that's going to be $400 that they tie up in your account. And on $1 spreads, like with the SPY, if you traded one contract and you got, say, 20 cents, that's only $80 that they're tying up in your account. So, you don't have to have a huge amount of money to do this. You can test the waters. You can dip your big toe in there. And Thinkorswim even has a really tremendous paper trading platform where if you don't want to risk any money at all, you can do this until you're comfortable with it and really prove to yourself that it works without actually risking any money. So it's pretty nice that way.
All right. Okay. And let's see. Russ is asking whether if he buys a package now, can they start in 2 to 4 weeks before Or
Russ, that's
can you wait
a really good question, and absolutely you can do that. In fact, I encourage you to do that. So if you sign up, go ahead and call the gals in our office. We got a 1-800 number, and I think it was posted just a couple of minutes ago. And just tell them, hey, I want to review the package. I want a chance to go through this before you start my 1-month subscription. And I encourage that. I want you to really feel comfortable and feel like you really want to do this and you're not confused.
All right. Is the 20% profit every 2 weeks, including all the losses? Yes, sir.
Well, the 20 to 25% is what we shoot for. So if the reason that I take it all the way down to 5% is that's if you really had a lot of losses, if you really had a hard time, that's the absolute minimum you could expect to make. But what we're really averaging, even with losses, with down months, with having it be tough, we're averaging 10 to 15%, and that's a reasonable expectation. If you talk to really experienced credit spread traders that have been around a long time, they'll tell you that's a reasonable expectation.
Okay, I'd say somebody's any specific delta range you look for selling legs of a condor?
Yeah, that's a good question. So we want to sell about a, we're selling a delta of around 15. In some cases, a delta around 10. So about 10 to 15 in there for a delta, and then we're really, instead of getting out at a certain delta, we're really watching the chart. So if we see some important levels of technical analysis have been breached, we're going to be looking to get out of that trade. But if they aren't breached, if it's trading within a prescribed range, with a high and a low, we just hang in there. And like I say, a couple of weeks isn't very long. That's only about 10 trading days, and then you're right there at expiration. So, the odds really are in your favor. This is a really nice way to trade over the long term.
Okay, all right. We got just a few more. Don, I don't know whether anybody could really give an account of performance over a year. Let's see. I just tried to order.
Steve,
okay,
we publish our track records. We publish our track record. I want the public to see what we're doing, so they can go in there and they can check it out and they can see how we've done. And this is just very. The reason I show that is I want people to see what you can do. And what's weird is I don't think too many other folks out there publish their track record. I think it's kind of rare.
Okay, and let's see. Craig said, I've tried to order and fill in all the info after clicking on the provided link by Becky, but it ended up nothing in cart. Can I call in the order?
You
Craig,
absolutely
yes.
can. So, yeah.
Use that 877 number.
Yeah, our customer service comes in the morning at 9 o'clock Pacific, so that's going to be 12 o'clock East Coast time, and we're here for the next 6 hours. And so go ahead and call in. If for any reason you get, if it's busy, just go ahead and leave your name and number. We'll get back to you right away. And our customer service, I think you're really going to like. These gals are really good. They're not just answering the phone. They really know the strategy. They're really good at it, so they can really help you.
Okay. How long is a special price for?
I'm going to let you. I know we're doing a recording of this webinar, so I want you to be able for people to watch if they can't be here tonight. So I'm going to leave this open through the weekend so people can watch it. On Saturday or Sunday and still take advantage of that special.
Okay, one last one. Is it correct that your strategy works better in a less volatile market condition? I'd say, Lance, any strategy at this point works better in a less volatile condition.
Right, yeah, I'd definitely say that's the case. And if you do have a lot of volatility, or if the market is definitely trending really strongly in one direction, obviously you want your spreads in the opposite direction. So you don't have to do a condor. You don't have to do two wings. You can just do a wing in the opposite direction.
Okay, is this system to auto trade and toss, or can we place the trade any other broker?
You can place the trade at any broker, and that's a good question. If you've got a broker that you really like right now, you absolutely can use that broker. Here's the thing, though, that's really important for you to know. I've tried just about every broker out there. I've got accounts open with most of them. I've got an account with Options Express. I've got an account with, oh gosh, Trade Monster. There's Options House. And here's what no brokerage has been able to do except for TOS is Thinkorswim has the ability to route your trade so they can get you right in the middle of the bid-ask spread. They're very, very good at getting you really good executions and fills. All these other brokerage houses out there, they advertise these really great commissions, and then when you go to trade with them, you find that you have to buy at the bid, sell at the ask, or excuse me, buy at the ask, sell at the bid. There's absolutely no leeway in there. There's no way to get in the middle of a spread, and that costs you so much more money than commissions do. You just absolutely get screwed on your trades, and you just don't know that until you open the account and start trading them. And so that's why I've done that with most of these trades. So when I promote Thinkorswim, it's not because we have some sweetheart deal with them. It's because they really do give. They not only have a great platform, but they can get you filled in the middle of the spread, and that will end up being hundreds, if not thousands, of dollars in increased profits to you over time, and it makes a huge difference.
Yes, and I will testify to that. Thinkorswim shows you what the price could be on that spread, and they will do it for you, and it's usually definitely in between the bid and ask area. So, all right, well, with that, I think we answered most of the questions. You can see the 877 number. If you've got specific questions, give their office a call. But Peter, very good information. And again, everybody, because you've got the benefit of seeing what direction a price is going to go, Peter's definitely going to show you what to do as far as taking advantage of that with a low risk, low profitability, but a high, high percentage returns or number of trades are going to go in your favor. So with that, we'll call it a night. Go ahead, Peter.
I noticed, just real quick, James Ray asks, how do you announce adjustments? Do you send text or emails? And when there is an adjustment on a position, I send out emails. And if you want me to send you a text on your phone, just give us that information. Give that to Alicia tomorrow, and we'll text you whenever there's an update. So yeah, I really want people to know what to do and when to do it. So yeah, we take pretty good care of you as a subscriber.
All right, great. All right, Peter, thank you very much. This was good stuff.
Thank you, Stephen. It's always really, that's okay. It's always wonderful to present to your people. They're always sharp and ask good questions, and it's just a real treat to be here. So thank you very much.
Well, thank you. All right, with that, everybody have a good evening. We'll see you in the chat rooms.